Now let's focus on Unit 2 of your CPA prep material, and basically we discussed already all of those concepts that covers the fund structure, different types of funds, and of course fund accounting. So far we learned all those governmental funds and all those tips that you can use to remember all those governmental funds: GRSPP, proprietary fund SE, GRAPS C, and then fiduciary fund CIPPOE. So now if you look at the materials that what I discussed so far, different type of funds and different type of statements that they prepare, and of course we at the beginning we learned that fund accounting or governmental funds basically uses the modified accruals. On the other hand, proprietary and fiduciary funds, they use regular accrual method accounting, and that focuses both on current and non-current assets and liabilities. Now we will check a couple of concept check questions. So question number 1, the economic resources measurement focus and accrual basis of accounting would be most appropriate for which fund as used in the fund financial statement. So for fund financial statement, remember that means these all three broad categories of funds, and within every category you have different types of funds, and we all know all those governmental funds of course use modified accrual, which is current financial resource measurement focus. On the other hand, proprietary and fiduciary, they focus on accrual. That means that focus all economic resources, including both like current and non-current. So now the question is here, the economic resource measurement and this accrual basis accounting will be most appropriate for which fund. So basically it could be appropriate for proprietary and fiduciary fund, not governmental fund, because governmental funds do not use the accrual basis. It just focuses on current financial resources. Now let's see the name of the funds. General fund, of course it's a governmental fund, so A is not the correct answer. Permanent fund is also under the governmental. C is the internal service fund, so it is actually under the proprietary fund. So I put all those tips here. So SE means internal service and enterprise funds. That means C is the correct answer. Of course not D, because D means capital project fund, which is also here. So if you can remember the classifications, then it would be easy to check the correct multiple choice questions. Again, for governmental funds is GRSPP, GRAFT. That means general fund, special revenue funds, debt service funds, capital project funds, and permanent funds. For the proprietary funds is internal service and enterprise funds. Now the last category, fiduciary funds, it's CIPP, and you can also remember POE, that means the last one is pension and other employment benefit funds, and CIPP, the complete all those elaboration of those letters are C is for custodial funds, investment trust funds, private purpose trust funds, and pension and other employment benefit funds. So basically if you know these tips, then you can easily identify and quickly answer the questions. Now this next question is, which funds would most appropriately use the current financial resource measures? So definitely we know current financial resource measures means here governmental funds, and that actually follows the modified accrual accounting. So you can easily focus on that. It's only governmental funds, so governmental fund will be yes, not these two other types of funds. Now this unit is again focused on the very detail of governmental funds, and it will focus on very common transactions and both sides of revenues and expenses. So we all know that governmental funds always follow the modified accrual method, and the focus is always current financial resource measurements. Now what are the areas then the accrual and modified accrual accounting may be different in terms of a governmental financial statements? So basically there are three areas that you will find that there is a difference between the modified accrual and accrual accounting. So one area is the budgetary control, second area is the activities, and the third area is the encumbrances. So you more or less are familiar with these concepts, but you are just taking it and recapping it again. So basically, so for the budgetary control, for accrual accounting, we actually don't record it, but for modified accrual, governmental funds actually records all those budgets. They do the journal entries for the budgets, and basically the main purpose is to control their spending. And budgets are based on some estimated revenues and expenditures, and at the end they can check what are the major sources of their revenues and how much they actually spend it in which area, and then at the end they can compare whether they are able to control those expenditures. So under the modified accrual, governmental funds will record all those budgetary entries. Now for activities purposes, so basically for these activity purposes is of course always on the current financial resource focus. And for encumbrances, we all are familiar with this concept. Encumbrances means any type of commitment or any purchase order. So basically this will also help for their budgeting control purposes. Now we will focus on couple of common journal entry format for your budgetary accounting, and we actually learned all those from chapter 16. And if you look at the CPA prep materials, you might find sometimes a little bit different terminologies, but conceptually all are same. So please be familiarized with all these concepts, and if there is any difference between the textbook and the CPA prep material, try to find out the basic concept. Sometimes some terms or some account title might be a little bit different. So basically for budgetary accounting, the government will identify all of their estimated revenues. So what are the sources of their revenues? So basically any government entity can collect their revenues through different taxes, right? So basically one of the major source, the most major source is tax, and that includes income tax, sales tax, property tax, or they can also collect their revenues from fines and penalties. So it is another source of revenues. So they can also raise their fund or collect their resource through bonds or notes. So these are kind of considered as other resources, other financial resource, and this is considered as a debt proceed. Definitely we will not consider as a bond payable or long-term liability. So for other resource, one of the main source of their revenues is debt proceeds. And sometimes they may have inter-fund transfer, and that could happen within governmental or sometimes maybe from other type of funds to any type of governmental fund. So the last type of source is inter-fund transfer. So basically these are the ways that any governmental entity can collect their funds. Those are the typical sources of the funds. Now if you look at the journal entries, and I just mentioned that one of the major difference between accrual and modified accrual is that under the modified accrual, governmental funds will record those budgetary journal entries. So budgets are basically based on your estimated revenue. So at the beginning of the year, you have to record all those estimated revenues. So the journal entry will look like this. All those estimated estimated revenues, how much you are going to collect through different type of taxes or any type of fees or penalties. So these will be your estimated revenues that you have to debit it. On the credit side, you have to show how you're going to use those revenues or those sources of funds. So basically there might be different type of categories or areas that you want to spend those, and those are known as appropriations. Now if you see that your appropriations are higher than your revenues that you are going to collect or your estimated revenues, that means you have a deficit. So these credit side appropriations are higher, that means this debit side has a deficit. In that case, you will have to show those deficits, and you can show it as budgetary fund. It's if it is debited, that means it's a deficit. On the other hand, you can find, which might be common at the beginning of the year, you can find that whatever their estimated revenues are, it is actually higher than their appropriations. That means in that case they have some surplus. That means in that case they are actually, this side, debit side, is higher. So these extra fund, budgetary fund, you can credit as budgetary surplus. Budgetary fund, then it will be surplus because your appropriations are lower than your estimated revenues. So that means for your budget journal entries, you have to debit your estimated revenues and you have to credit your appropriations. Appropriations means how you're gonna use all those revenues for different functions. It could be different type of activities. And now if you see the difference, then depending on which side it is lower and higher, you will show it. If debit side is lower, then it will be a deficit, budgetary fund deficit, and if its credit side is lower, then you have to show it as a budgetary fund surplus, because here surplus means you have more revenues than your appropriations. Now at the end of the year, what you need to do, at the end of the year, you have to close your journal entry. So the end of the year, the journal entry will be just the opposite. Whatever you did, you have to do the opposite to, or do the reverse thing to close the journal entry. So at the end of the year, the reversed or the closing entry, closing budget entry will be just the opposites, and you have to, initially you credited appropriations, now you're going to debit it, and you debited estimated revenues, you're going to credit it, and depending on whether you had a surplus or deficit, you will also close that part. Remember the textbook use the term budgetary fund, and the CPA prep material use the term control. That means they use the term budgetary control. So conceptually both are same. Now for the next part, we will focus on non-exchange revenues. So non-exchange revenues means those type of revenues and where the service is not exchanged at that moment. So governments are kind of collecting different type of revenues without giving any direct service at that moment. So these are called non-exchange revenues, and we actually discussed and learned those when we went over the chapters, and there are different types, and I'll recap that, and then we will see few journal entry problems. So there are different types, basically 4 types of non-exchange revenues. The first type is called the derived tax revenues, and these are the major source of revenues, which includes income tax and sales tax, because these are derived based on some actions and service. Now the second category is imposed non-exchange revenues, and those are kind of imposed by the government, and one example is the property tax. Now the third category is government mandated non-exchange transactions. So sometimes government can mandate certain activities, and those could be kind of conveyed from, those type of resources could be conveyed from one governmental entity to another government for some required programs. For example, federal government can transfer a specific fund to a state government or to another local government. These are known as government mandated non-exchange transactions, and those are actually for some specified required programs. The last type of revenue category is the voluntary non-exchange transactions. So these are basically some sorts of grants, and that could come from any other governmental entity or by any individuals or any organizations. So these are the 4 types of revenues. Now we will see some property tax journal entry problems. Now let's see the example of property tax journal entries. So basically when property tax will be recorded when it is billed, so here initially it will be shown as a tax receivables. So for this year, a governmental entity actually estimated $1,800,000 property tax that they are going to collect. So they will debit real estate property tax receivables, and this is the amount, 1,800,000, and at the same time they estimated that 10% of that may not be able they will not be able to collect. So this is 10% of it is uncollectible, so they will show it as allowance for uncollectible tax. This is for your current periods, because remember, this basically will focus on current year's receivables and revenues. So after calculating this allowance, the rest of the amount they will record it as a revenue. So basically when they build those property taxes, they will record this revenue, property tax receivables, and of course credit the revenues property tax, but at the same time they will adjust the allowance for uncollectible tax. Remember, this allowance is kind of used as a contra revenue, and that is reducing your revenues. So the whole amount, 1.8 million, is not the revenues. After subtracting those allowance, we are showing the remainder as a revenue. So this is not used as a bad debt expenditure. This is directly reducing your revenues. Now at the end of the year, they are able to collect $1.458 million property tax. That means they are collecting cash is debited, and then they have to remove the same amount from their receivables. So their receivables, they initially recorded as 1.8 million. Now they collected 1.458 million, so they will reduce or credit receivables. Now remember, there is a difference between their total estimated or tax receivables between this amount they actually collected. So this difference is basically known as the delinquent amount. So now they have to reclassify their receivables. So 1.8 million receivables were at the beginning, they collected 1.458, and they still have amount, which is, if you subtract it, 1.8 million, and if you subtract here 1.458 million, so this difference is basically the amount. This amount we have to reclassify. We have to remove it from the current receivables, and we have to call them as delinquent receivables. So remove means we have to credit or reduce those as the property tax receivables current classifications, and then we were recording the receivables again, but we are releveling it or reclassifying it as delinquent receivables. Now we need to do some adjustments with our allowance for uncollectible tax. Remember, initially our allowance for uncollectible amount was 180,000. So now these allowances, we thought at the beginning of the year that we will not be able to collect. Now at the end of the year, you found that you actually didn't collect here the amount $342,000. So basically now this will be your new allowance, because you actually don't know whether you will be able to collect this amount or not. So we will call them as allowance for uncollectible taxes, but it will be as a delinquent classification. So we will record this allowance and will classify as delinquent, which is crediting allowance for uncollectible taxes delinquent, and then we have to remove these allowance for uncollectible taxes current portions. That means it was initially 180,000, but we are kind of reclassifying the allowances and adjusting these things, so we have to remove or reduce it. Initially this allowance was a credit item, so we gonna debit this allowance, the old category, I mean the allowance as a current category, so we're gonna debit it, and the difference between these two, which we have to remove from our revenues, which is 162,000. So we will adjust with the revenues, so we will reduce it by debiting revenues. This is how it works for real estate taxes. And if you have any uncollectible amount of tax, or if you have any delinquent tax, then this is how we're gonna do the journal entries. Now, few other points on revenue recognitions. So you have to remember two requirements for your revenue recognition. One is time requirement. Remember, for time requirement means revenues are recognized when the resources are used or use may begin. And this is actually for all non-exchange revenues. So far we discussed those non-exchange revenues, different categories. So revenues will be recognized when the resources are used. Now there is another requirement which is called eligibility requirement, and which is basically for government mandated and voluntary transactions, and that should actually has a time requirement, and it also includes some required characteristics. That means the resource providers may provide certain characteristics, and that should be made. Reimbursement means that expenditures must be incurred before revenue is recognized. And contingencies, and it is contingencies only for voluntary transactions, and actions must be taken before revenues is earned. Now you also need to take a little notes, because it's a little bit confusing that basically when revenues are earned, we just discussed different type of non-exchange transactions and revenues. Please take a note and remember, for real estate tax, fine and property, revenue is actually earned. That means you have to record the revenues when those are billed. For income tax and sales tax, revenues will be earned when those are received. For restricted grants, you will record revenue, or revenues will be earned when you spent it for that specific purposes for which the grant is given. That means when you spent it, you will record the revenues. And remember, all these are subject to measurable and collectible within 60 days of the end of the years. That means you should be able to measure all those amounts, and it should be collectible within 60 days of the end of the years. So those should be measurable and collectible within 60 days of the end of the years. So if any revenue is collected in advance, or if any real estate tax is paid in advance before billing, that it will be considered as unearned revenues. So now our next item is expenditures, and we will focus on different type of expenditures. Remember, for governmental funds, all amounts spent on different type of operations, even debt payment or any type of capital asset purchase, all will be considered as expenditures, because the focus is current financial resources. And under the modified accrual accounting, we actually don't record any capital assets, any acquisition of long-term or capital assets. Everything is considered as an expenditures. So paying a police officer's salary or purchasing a police car, both will be recorded as expenditures. Now there are a few other items, those are a little bit different. Those are supplies and prepaid expenses, and you have two methods. We actually discussed it. I'll again recap so that you don't forget. One is called the purchase method and another is called the consumptions method. So I'll make a quick notes and you can take the note or you can follow my lecture later. So again, for expenditures, all capital purchase, debt payments and operating expenses all are classified or considered as expenditures. For supplies and prepaid expenses, there are two methods to record it. One is called the purchase method and another is called the consumption method. So under this purchase method, when you purchase the inventory, you have to show the whole amount as an expenditure. So when you are purchasing, the entire amount under the purchase method is an expenditure. So you debit expenditures and you can label it expenditure on the purpose of supplies, and then you credit voucher payable. Now under the purchase method, at the end of the year, you have to look at your unused supplies. So these are the remainder. So then you debit those unused supplies or inventory of supplies, which is considered as the current assets, and then the remainder you actually credit as a fund balance. And for fund balance there are separate categories, different categories, and it is also labeled or under the non-spendable fund balance, because this you cannot use it, because this balance is for those supplies. So this is the purchase method. Now let's look at the consumption methods. For the consumption methods, when you purchase, you show the supplies as a current assets. So you debit supplies or you debit inventory of supplies and you credit voucher payable. For both assumptions is that you are not paying cash right away, so we are crediting voucher payables. And then when you use or consume your supplies, then the portion that you are using and consuming, you're going to show it as an expenditure. So you debit expenditure and you reduce the portion from your current assets, supplies. So these are the two ways to record supplies and prepaid expenses. Now if you look at the rest of the materials, it also shows different classifications of the expenditures. So basically expenditures are classified according to the specific funds, and within the funds expenditures can be classified based on either functions, units, activities, or different type of objective classes. Now remember, purchase of fixed asset is not capitalized, rather it is considered as an expenditure. And proceeds from long-term debts, we know that it is considered as other financing source, not bond payable. Now the payment of your long-term debt, that means when you pay any portion of your principals or any interest, both are considered as expenditures. So these are all about the expenditures. Now we're gonna do some quick concept check questions. Now few journal entries on expenditure from your CPA materials and some quick concept check questions. So as we mentioned, all type of expenses, even for capital project spending, will be considered as expenditures. For example, they say they buy a police car. Apparently it's a long-term asset and it's of course non-current capital assets, but they will show it, debit it as an expenditure. They can also label it like expenditure police car, and we are assuming it's on credit, so they're gonna credit voucher payable. Now here I also mentioned about the bond proceeds. If they issue bond, they are receiving cash, but these proceeds will be considered as other financing source. Bond proceeds, or they can label it as bond issued. Remember, they cannot credit bonds payable because this is current financial resource measurement focus. So we cannot show any long-term items or long-term liability or long-term assets. Now when they're gonna pay it, the next journal entry shows that they are paying $125,000 principals and $100,000 interest on those long-term debt. Both of the items will be considered as expenditures and they are paying cash, so cash will be credited. Now let's take one conceptual problem. Sample CPA question. Rich Township's governing body adopted its general fund budget for the year ended July 31st, year 1, and their estimated revenues is 100,000 and appropriations, that means how they're gonna use the revenues, that is 80,000. Now you can imagine the journal entry, how they should record the journal entry. They should debit estimated revenues. They're gonna debit estimated revenues, which is 100,000, and they will credit the appropriations. So appropriations is 80,000. So now look at the journal entry, which side is higher or which side is lower. Actually the credit side is lower, so that means their revenues is higher than the appropriations, so they will show it as a surplus. So they will credit budgetary fund or budgetary control fund surplus. So they're gonna control here, they're gonna record this remainder as budgetary control fund, or you can also call it label it as surplus, which is 20,000. So that's the basic journal entry they're gonna do at the beginning of the year. So now to record the appropriations, what they should do, they should credit the appropriations control. So the answer is A. Now let's see the next one. Rich Township's governing body adopted its general fund budget for the year ended July 31st, year 1. Estimated revenues is 100,000, appropriation 80,000. Okay, to record the 20,000 excess of estimated revenues, so what they need to do, we actually did it, this is the same number, so they have to credit these remainder $20,000. These are excess of their revenues, so they actually credit as a budgetary control or budgetary fund surplus. So answer is C. Now the next question, the following information pertains to property tax, real estate or property tax. This levied by Oak City for the calendar year 1. And now you see the collections during year 1, estimated collections within first 60 days of year 2, then year 2 for the remainder, and year 3, and they have also uncollectible. So we just learned that when you have to record all those should be measurable and collectible within the 60 days of the end of the year. That means they are collecting this 500,000 in year 1 and these another 100,000 within the first 60 days of year 2. That means these two will be recorded as their property tax revenue for the year 1. So the correct answer is 600,000.